Let's have a look at some examples around the scoping part of it. For example, it says that processing of grapes into wine by a vintner who has grown the grapes. So in this case, the moment you say that you have a natural produce like a grape, right, and if you start processing that and convert that, let's say, into a wine, which is a byproduct of the processing, right, or which is the product out of this further processing. So that processing is not something which is covered within the definition of this particular standard, right? So even though you might want to call it that this is the reason why probably the grapes were let's say that entire processing was done so that you can actually make a wine out of those grapes, but then that processing would not be a part of a natural or a biological transformation of the produce, right? It's more of a a purpose which is not a natural or a natural objective of, let's say, having a grape available. Okay, so even though your objective runs in making a wine, so till the time it's a grape, right, till the time it's a produce which is an agriculture produce, yes, Ind AS 41 is applicable. But the moment that natural transformation or natural transformation is happening, only to that extent that would be a part of, let's say, this standard. The moment the processing happens, let's say getting into a wine or something, then or something else for that matter, so that would be excluded from the scope of this standard. Okay, we discussed that agriculture produce like wool, meat, fruit, rubber, logs, etc. Till the time they are available in their actual form, they're all a part of this particular standard at the point of harvest. But the moment it goes into the next stage, for example, wool being converted into a yarn, or let's say using for some preparing some threaded yarn is the better word, of course. You look at, of course, the chicken, we use the word meat, or the fruit being, let's say, processed further into some juices. You have lactose from the tree, which is converted into rubber, etc. So they're all going to be excluded from this particular standard in that context. Okay, very briefly, we should be aware of it. What are the key definitions? We say a biological asset would include any living animal or plant. We've discussed this briefly already, of course. And agriculture produces basically the harvested product of an entity's biological asset. The milk, the wool, the tea leaves, for example, they're all examples of agriculture produce. Harvest is basically the time at which that produce is detached from the biological asset, right? Or, for example, let's say the cessation of the biological assets life processes, right? So anything which was happening as a process in the of the nature, that's something which is the key. And the moment that process is over, or let's say either as a natural transformation, or it's picked out, it's detached from the produce itself, the point of harvest comes in the picture there. Okay, say, for example, let's say if I look at it, I'll use an example reference first. I'll come to the slides in a minute. Here we go. So if I say that I'm looking at biological assets, sheep, trees, plants, etc., they would all be example of biological assets. Agriculture producer would be wool, felled trees, cotton, harvested cane, etc., in case of sugar cane. But then you look at, of course, the produce, yarn, carpet, logs, lumber, thread, clothing, etc. Sugar, for example, in case of sugar cane. So till the time you're talking about this phase, it's all Ind AS 41, right? The moment it's moving out of the point of harvest, Ind AS 41 loses its scoping there, right? So let's go back what we had missed and what we had not covered in the discussion. So just to conclude on this part, in terms of up to what point in time, what point in time do you include something as a part of Ind AS 41 is something that we have tried to cover briefly. Okay, let's have a look at some further definitions. This is, again, you should know broadly the meaning. You don't have to really remember it word to word. Okay, so when you look at it, let's say I'm looking at a biological transformation is a natural growth or natural process, let's say the process of growth, degeneration, production, and procreation that results in qualitative or quantitative changes in a biological asset. There could be, for example, there could be, you know, a complete or let's say there could be cattle that I'm managing, right? Maybe I'm running a dairy farm. Okay, so a natural transformation of that cattle could be, the birth of a calf, for example, right? So this is all going to be a part of biological transformation. So both the cow or the buffaloes and the calves, for example, they're all part of biological assets. Okay, so that's the biological transformation we are talking about. In agriculture activities, the process of biological transformation and harvesting, for example, for sale or conversion into agriculture produce or into additional biological assets would be a part of agriculture activity, which actually means that if I'm managing some animals at a zoo, they are not going to be covered with this particular standard, because even though there is a biological transformation taking place, it is just incidental to running that zoo. The zoo is a business, not an agricultural activity. Okay. Similarly, if I say that there's a pharmaceutical company which is managing some, let's say, plants for their research purposes. Okay. So it would be difficult to establish sometimes whether that growth of the plant, which is for research purposes, is essentially an agricultural activity. Unlikely. Okay. So that could be very specific to the pharmaceutical business there. Again, not something which is relevant from an examination standpoint, but in general, you should be aware of the scoping part of it, of course. Okay. This is something we have discussed under Ind AS 16 very briefly, but it is a detailed, a definition provided here. A bearer plant is again a plant. There's no denial on that, right? But it's a living plant, for example, which is used in the production or supply of agricultural produce, right? And by the way, importantly, is expected to bear produce for more than one period. A tree, for example, okay, could be a definition of, let's say, a bearer plant. Now, importantly, why do we need to know this? Because a bearer plant is indeed an example of Ind AS 16, not Ind AS 41, right? Wherein you look at, of course, either the cost or revaluation model, right? Ind AS 41 is a very different standard in terms of the measurement, right? So what we're saying is a bearer plant is a living plant, for example, which is used in the production or supply of agriculture produce for more than one accounting period, and it has a remote likelihood of being sold as agriculture produce, okay, except for incidental scrap sales. So there could be some plantation which grows on its own, okay? So very likely, for example, that could be a part of incidental scrap sale, and that would not be distinguished as or considered as a bearer plant. Similarly, if I look at, a sugar cane, I'm doing the farming of sugar cane. So that does not have, for example, a more than one period in terms of creation of the produce. So those would be clearly agriculture produce and not bearer plants. But then if you look at the tea bushes, grapevines, palm trees, rubber trees, they would very likely meet the definition of bearer plant, and accordingly, they would become a part of Ind AS 16. But importantly, you look at the grapes, tea leaves, fruit, latex, they would all be a part of an agriculture produce, and that is where the accounting would fall under Ind AS 41. So just a distinction between the two sides there. Okay, we have covered this example already in terms of what is there and up to what point in time Ind AS 41 is applicable, and after that, of course, after the point of harvest, right, the Ind AS 41 loses its relevance there. Okay, so very quickly, let's revisit this part. It says that what we want to do is basically the very idea of the standard in place is to understand the accounting and understanding management of the transformation. Scoping in is basically biological assets, agriculture produce, and government grants confined to those biological assets. Okay, what is scoped out is any land, agricultural land, any license to operate, for example, such kind of land or plantations, etc. Government grants related to bearer plants, even the bearer plants, both of them are excluded. And the right of use asset for the lease of land, etc., is also excluded. There are different standards which take care of these, right? But we also covered about the key definitions, not exactly critical from an examination standpoint, but in general, you should be aware of it. What would, for example, be a biological asset? We talked about, a living plant or an animal would be an example of a biological asset, right? So there are broader definitions that you should be comfortable knowing here. Okay. Now, the critical part here, the important part is, of course, to look at the recognition and measurement. You still want to remember fair value less cost to sell at any point in time. If it's an agriculture activity, if it's an agriculture produce, we are essentially talking about fair value less cost to sell. Okay. So how do we look at it? We say we recognize a biological asset or an agriculture produce. And interestingly and importantly, we are talking about the benefits are expected, the control is there, okay, and then the fair value or the cost can be measured reliably. This is the fundamental requirement for any element of a financial statement to be recognized with respect to an asset. Like even for an asset, we said, right, that if the benefits are probable, there's a control, and of course the value or the cost for that matter of that asset can be recognized or can be measured reliably, then only you recognize. And that's what is the requirement, even for a biological asset or an agriculture produce. Okay. Importantly, if I say as an example, it says that control of livestock is normally evidenced by legal ownership and the branding or otherwise marking of the animal on acquisition, birth, or weaning, right? Control of newborn lambs could be evidenced on birth and not only on weaning. Separate biological assets will be recognized when the lambing has proven successful and the offspring are healthy, right? So we're simply talking about that the next generation of, or the next breed of let's say the animals which are obviously coming out, let's say as a part of biological transformation, they would be also recognized, right, as a part of your biological assets, right? And they would be, of course, considered that yes, there are future benefits expected, the control is there, and of course the value can be measured, right? So normally you would expect that for any biological asset or agriculture produce, normally the fair value is assumed to be available, it's measurable, right? There are markets wherein all these items, all these biological assets or agriculture produce are being traded, so we need to assess that part as well. Okay. Similarly goes for the agriculture produce. The fresh fruit bunches growing on, let's say, palm oil plants should be fair valued while they grow, because once they're harvested, naturally the process would be over. That's where you start looking at, again, the recognition part of it, right? Measurement, as I said before, fair value less cost to sell at any point in time, if at all. Very rarely, although the standard expects you to be knowing it at all times. If not reliably measurable, then these are stated at cost less any accumulated depreciation or impairment loss, right? Again, rare, but then could be a possibility also. Okay. Now, even if you are measuring them at cost less depreciation, less impairment losses, if and once the fair value becomes reliably measurable, then you actually start using that as a standard benchmarking. So you need to be, again, looking at fair value less cost to sell as an appropriate, let's say, measurement criteria for all biological assets at any point in time. Okay. Finally, as we said that, that when you look at, let's say, some specific instances, let's say, for, let's say, a birth of a calf, or maybe it could be a, even growing a particular, let's say, plantation, right? So sometimes the cost may be equal to the fair value when specifically little biological transformation has taken place, or the impact of that biological transformation is not significant. So in those cases, it could be the case the cost is as good as the fair value. So you don't have to really do a lot of effort to identify or measure the fair value just like that, right? But then by default, fair value less cost to sell is the right measurement criteria at all point in time. Okay. This is just about understanding that the produce harvested is also measured at, of course, fair value less cost to sell at the point of harvest. And as we were discussing it, that we assume by default, we assume at all point in time that the fair value of the agriculture produce at the point of time, at the point of harvest, can always be measured reliably. That's the underlying thought. That's the underlying assumption from this particular standard, right? In an examination, of course, you would normally see the fair value less cost to sell being provided to you. So don't really have to worry too far about the how to really practically determine the fair values. But in general, you should be knowing that it can be difficult, right? So any changes in the value are taken to the statement of profit or loss. That's something that we had as well discussed in the past. Okay. Fair value measurement, you would need to assess, right? There are multiple ways in which this can be done, but you would probably look at it that a discounted cash flow model or a cash flow model could be a very likely, a very appropriate valuation model for the bearer produce. Okay, so what you're doing is basically you're looking at basically what is the cost of, for example, if it's a newly born calf. Okay, so you know that this calf has a natural life of several years, right? So you know that there would be a cost of, let's say, managing that calf as it grows. Of course, you have to provide him all the essentials for his breeding, for his growth, right? And you know that after that calf has matured and starts resulting in giving produce, okay, let's say in form of milk, for example, when it is a fully grown animal. So you're looking at all those cash outflows while of course doing that upbringing of that calf, and then of course the inflows which are expected to arise, let's say when you are let's say having the milk as an output, and of course you look at the value of that milk and bring all those aspects. So the whole idea is that all directly attributable cash inflows and outflows would be considered when you look at the fair value measurement of, let's say such a calf, for example. It could be, for that matter, any such biological asset, right? And this would also be the case, for example, a bearer produce. It doesn't really change anything. A wool, for example, we know that if you were to sell it in the market, either the price is available or else you look at a discounted cash flow price for that as well. Okay, the cost to sell would be simply the incremental cost, for example, the commissions or any levies by the regulatory agencies, any transport tax or duties, but it does not include transportation costs. That's already a part of course, the fair value. Any interest costs aligned to that, or even taxes. So they're all simply, these are more operational, or let's say with respect to the cost of money. They're not related to the, let's say the agriculture produce or the biological asset per se. Okay. Let's have a look at a small scenario here. It says that Alpha Limited owns a cow which is recognized as an asset in its financial statement. It's a biological asset, of course. Close to the end of the reporting period 1920, the cow gave birth to a calf. On the reporting date, the fair value less cost to sell is estimated at 30,000 rupees. The question is, how should Alpha treat this fair value less cost to sell in its financial statements? You're simply saying you have a biological asset. So you debit biological asset and credit the gain, right? That's where it sits. The entire gain would be shown through the profit or loss. So we're saying biological asset 30,000 rupees, debit, and credit gain through P&L, of course, 30,000 rupees. And that's what it is. We're saying that Alpha Limited should recognize the calf at its estimated fair value less cost to sell of 30,000 rupees as a biological asset and report a gain through statement of profit or loss. Okay. Let's have a look at another scenario. It says that Beta Limited is engaged in the business of agricultural activities. The company owns a dairy herd of 300 cattle, which are average 3 years old as at 1st of January 2020. The fair value of the herd is 15 lakh rupees. So there are 300 cattle worth 15 lakh rupees. Fair value information on 31st of December 20 is provided as below. For a 3-year-old cattle, right, the value is 5,500 rupees per cattle, but for a 4-year-old cattle, the value is 6,500 rupees per cattle. The question is, at what value should beta measure the cattle on 31st of December, separately identifying the movement due to price and physical change. Now, importantly, what you want to remember here is that we know candidly there are 300 cattle and the average price, because as on 1st of January, these were 3-year-old on an average. Of course, they have grown by 1 year, and that's what we're looking at, 6,500 rupees as the value. So ideally speaking, I should be looking at my total value of 6,500 into 3, right? That comes at, for example, that would be 6.5, 13, and 6 is 19,50,000 rupees. Okay. But this question wants us to also calculate what is the movement due to price and what is the movement due to the physical change. Okay. So what are we trying to bring here is that we are saying my number is 300, value is 15 lakh, the total value is 15 lakh, which means that per cattle it becomes 15 lakh divided by 300, which is 5,000. Okay. Now, in terms of the value, it has changed from 5,000 to 5,500. So the one change that you look at is there is a change that you see to the extent of 500, which is basically on the value of these 300 cattle. So that becomes, of course, 4 zeros, and then we have 15, 1.5 lakh, right? And in terms of, so this is the price change that we are referring to. A 3-year-old cattle at the start was worth 5,000. A 3-year-old cattle at the end is worth, let's say, 5,500. So 1.5 lakh is basically your change due to price. And of course, in terms of the physical change, right? The physical change we are talking about 6,500 is the value that we have got for each cattle, right? And then again, we are referring to the base price of 5,500, which means that the incremental change is 3 lakh rupees, right? So effectively, this amount any which ways comes at 19.5 lakh, but then that split off. So this entire gain of 4.5 lakh is divided between the price change as well as the physical change. That's the way you start looking at those gains being identified on these bases, right? From an accounting perspective, we may say there's a change. So you would increase the value of the biological asset by 4.5 lakh rupees and credit, of course, gain to the extent of 4.5 lakh rupees. There's no problem with that. But in this case, we might as well be required, for example, if the examination wants us to calculate that, we might as well be required to split. It's basically a reconciliation of 4.5 lakh rupees in terms of what is the change because of the price changes and what is the change because of the physical changes there. Okay. But overall gain would, of course, remain 4.5 lakh rupees there. All right. Let's have a look at the formal solution. We're looking at, of course, the criteria for measurement is, of course, the biological assets would be measured at fair value less estimated point of sale costs. The fair value, of course, is measured that basis. The price changes to the extent of 1.5 lakh rupees. The physical changes on account of that 1 year old maturity, 1 year's maturity to the extent of 3 lakh rupees. The net value is 19.5 lakh. The overall gain of 4.5 lakh is reported through statement of profit or loss. Okay. Let's have a look at this question as well. It says that on 1st of December 19, Venus Limited purchased 150 sheep from an entity at 6 lakh rupees. All right. So this is the number of units. This is the total value. The sale involves a transaction cost of 3%, which was paid by the seller. So effectively talking about 18,000 rupees, which is the 3% cost on 6 lakh rupees, right? The seller, let's say, paid for that. On the reporting date, which is 31st of March, the fair value has increased from a 6 lakh rupees to 7.5 lakh rupees. But this is also subject to a 3% transaction cost to be incurred by the seller to bring the sheep to the relevant market. Now, on a 7.5 lakh rupees, 3% would actually come at, let's say, 22,500. The question is, what is the fair value of the sheep on the date of purchase and on the reported date? Also provide the journal entries. What do you want to remember always? No matter the date, you always measure your biological assets or agriculture produce, as the case may be, at fair value less cost to sell. Okay, what does it mean? It simply means that if I'm paying 6 lakh rupees, naturally it's an outflow of 6 lakh rupees, but the transaction cost, even if it is borne by somebody else, I need to book for that, account for that in my books. So this would be 5,82,000, which is nothing else but 6 lakhs minus 18,000. Credit, of course, bank. I'm paying 6 lakh rupees. This by default becomes my expense in my books. Okay, that's what you want to remember. The second part is the net value is 7.5 lakhs, like minus 22,500, which basically comes at 7,27,500. So from a 582, this value has changed to 7,27,500, which gives me a gain of, for example, 1,45,500, right? So if this value is changing, it's increasing, I would say my biological asset would be measured at 7,27,500, which means there is a gain of 1,45,500. I would do a credit, of course, to 1 lakh, to my P&L to the extent of this 145500. Okay, this is where you look at, of course, recognition of biological assets at fair value less cost to sell. And now you're looking at, of course, the measurement at reporting date at, again, fair value less cost to sell, right? Use this amount as a reference in terms of how did you arrive at it. Okay, let's have a look at the formal solution. Also, we are putting it like this. There's a purchase of a biological asset for 6 lakh rupees, but the effective value, the net value, of course, is 5,52,000 rupees to be recorded in the balance sheet, right? Similarly, you look at, of course, the gain which is arising, which is 1,45,500, and you shall be recognizing it likewise. Looks okay, comfortable. That's something which is broadly the perspective. So far, all we are saying is what we have done. We are saying that look into it, what is covered as a part of the standard. That's more important, right? What is in the scope of the standard, right? We said biological assets, agriculture produce up to the point of harvest, and everything else which is into the processing that goes through some other accounting standard, right? And the second part is, of course, the measurement at any point in time is done at fair value less cost to sell. All right. There's another example here. Let's have a look at it as well. It says that on 30th of June 19, Popular Limited purchased 200 cattle from an auction for 3 lakh rupees, but it involves also an auctioneer fee of 1%, which of course is coming at 3,000. Right? I might say here that the value of those cattle is 2.97 lakh. Just while we're reading it, we are looking at this particular aspect. On the reporting date, which is 31st of December 2020, the fair value has increased from 3 lakh rupees to 4 lakh rupees. But the auctioneer fee is applicable to the extent of 1% to bring the cattle to the relevant market. The question is, what is the fair value of the cattle on the date of purchase? We calculated that 2.97. And what is the value on the reporting date, which is 4 lakh minus 4,000, which becomes 3.96 lakh. right? Exactly the same question we just did a minute ago. It's not at all different around it. We're looking at a difference of 99,000 rupees as a gain through my statement of profit or loss. All right, let's have a look at this solution. It says that a biological asset shall be measured on the initial recognition and also at the end of reporting date at its fair value less cost to sell, which means that the value on the date of purchase is 2,97,000 and the value on the reporting date is 3,96,000, which means there's a gain of 99,000 recognized through statement of profit or loss. All right. Thank you very much.